Hello, everybody. Thanks again for joining us here today. I'm lucky enough to be with Chris Foster. He's one of the fund managers at Liontrust. How you doing, Chris? You doing okay?
Yeah, very good, thanks. Yeah, good to see you.
Excellent, excellent. We'll come on to Chris in a minute. We're going to talk today about the Liontrust Sustainable Futures US Growth Fund. The great fund that we have in our portfolio. I don't want to steal Chris's thunder too much because he's going to give us a little pot of history to remind us who Liontrust are and some info about the fund. I did do one of these recordings with one of his colleagues, Peter Michaelis, a few weeks ago. So there's lots of information on Liontrust there, but there's no harm in doing a little bit of a potted history of where we're at right now. So over to you, Chris. Do tell me a little bit about Liontrust and about this fund, why it came about, and some information about it. That'd be great.
Yeah, sure. And thanks again for having me on. It's great to be here. So Liontrust is a UK-based asset manager. It's publicly listed and has about 27 billion in assets across the business. But really, it's quite a boutique asset manager with different investment teams. So there's actually 7 different investment teams across the organisation. And as you mentioned, I work for the sustainable investment team. Which is the one that Peter Michaelis, heads up, and you've had him on before, and of that 27 billion, about 10 of that is run by our team across equity and fixed income and multi-asset products, and really it's all got a sustainable focus. So our investment process is founded in sustainability, and that's all that we do and all that we've ever done as a team. So I joined the team about a decade ago now. I'm a co-manager on the global growth funds, and I'm a lead portfolio manager on the more recently launched US fund.
Okie dokie. So just tell me a little bit, why did you feel the need to, because you've got other funds, European fund, etc., managed funds. What was it that you thought, well, that we really need to develop a US fund here? What was the reasoning behind that?
Yeah, look, it's a fair question. So to be fair, a lot of it was driven by clients asking us over the years. They considered really a bit of a gap in our offering, because we've got pure UK, we've got UK equities, we've got European equities, we've got global equities, and then we've got a plethora of fixed income products as well. And for those clients that wanted to do their own asset allocation and they wanted to decide exactly how much they've got in the US versus Europe and versus the UK, etc., they were looking for a sustainable product that was just US focused. And to be frank, I think there just wasn't that many pure play sustainable funds out there to choose from. So I think that was part of the drive. And clearly, being investors in global equity funds, the team has been managing global equity funds since 2001. So we've got this long track record of investing in the US through that fund. So it wasn't like we were starting from scratch. I mean, I think if we were to launch an emerging markets fund, sustainable fund, you need a lot more resource to bolster the team, and because it's not an area of expertise that we've got. But really, the US focus is carving out what we've been doing for many years. So that was the genesis of the idea, and we decided that actually in 2023 that was the right time to do it from our team's perspective.
Right. Okay. So it just really does seem like a proper natural progression, and of course the US is such a major market. It makes sense to do that. So in terms of the fund, just tell me a little bit. So typically, how many underlying holdings are there? What type are they? Large businesses, small businesses? Tell me a little bit about that type of stuff.
Yeah, and actually, in being asked to look at this, it was a useful exercise in making us look internally at what drove the global fund, and to see how important or not the US stocks in that fund were. And when we look back over the previous 5 years before we launched the fund, so March 2023, when we last did this analysis, about 80% of our returns came from that US portion of the portfolio, despite the US portion only being about 60% in terms of weight of that global fund. So that gave us the kind of confidence, because when we looked at the performance of that kind of sleeve, it significantly outperformed the US benchmark, the MSCI index, without owning the likes of Microsoft, without owning Facebook, without owning Tesla, without owning Nvidia, and really that is something that we're quite proud about. Really, is that you can outperform, we think, the benchmark in the US, even if you don't own all of the Magnificent Seven. It's not necessarily easy, but that gave us the confidence to say, okay, look, this is something that we can do, and something that we're really excited about doing. And then it came to think about, well, how do you structure a product like that? And it's very similar. So think of it as it's a very similar product to all of our other equity products. It's a little bit fewer. There's slightly fewer names on the US side, just because it's a single country strategy. So more like 35 to 55 instead of 40 to 60 that we would have on the global fund. So just slightly more concentrated, but these 43 names in that portfolio currently in the US fund. And we've got a long time horizon, so 5 years plus is our typical time horizon. So when you're thinking about idea generation, we're really looking for 8 new ideas a year, maybe 9 new ideas a year, across a team of 10 equity analysts. It's completely within our boundaries to be able to do that. And the idea is that the really fantastic ideas that get into the US fund can also end up in the global fund. So that's just give you a bit of a flavor of how those products kind of sit alongside each other. And it helps because I co-manage the global fund and I lead manage on this strategy, and Simon, who leads on the global fund, is also co-manager on the US strategy. So there's a lot of overlap in terms of how we think about structuring the portfolios and the types of ideas that go in. Just to conclude, I would say that the US obviously has, because it's a smaller fund, it's about $100 million fund at the moment. That just gives you the ability to go a little bit further down the market cap. So across our range, because of our focus on sustainability, we do tend to be led outside of the mega caps. So, if you're looking for a fund that owns all the Magnificent Seven, in big positions, that's not how we do things. And that's just an output of our sustainability, our focus on sustainability. It leads us away from those names. So we tend to be a bit more mid-cap focused, mid-cap bias, and a real focus on growth from that. I'm sure we'll go into the details of our investment process later, but really a focus on growth and a focus on mid-cap. And I would say that the US fund has the ability to go a little bit further down that market cap in terms of where we can fish, just from a liquidity perspective, which is very exciting, because the US market is huge, and there's just so many fantastic companies out there that are solving real problems from an environmental, social perspective that we think fit our process really well.
Oh, that's really good. Yeah, so a very well diversified fund. You've got all that assistance from your colleagues. You can share ideas, etc. You've mentioned there's some mid-cap exposure. For anyone who doesn't know, capitalization, so the size of the business. Mega caps are all the really big players, and the Magnificent Seven, of course, are the big, most successful ones that are out there in the US, Facebook and Google, etc. So in case you're not familiar with that term, that's brilliant. We'll go into some examples in a bit, but just before we do, just remind me, I mean, you guys in your Sustainable Futures team, you live by these 3 overarching themes, and you look for companies that fit the bill. Just give me a couple of minutes insight, if you will, just to remind us all what those themes are and why they're important.
Yeah, absolutely. And you're right. This focus on sustainability themes is really the heart of the process. It's the starting point of how we look for ideas. And we categorize them under, we call them mega trends. These 3 mega trends, which very simply put are a belief that the world becomes over time cleaner, healthier, and safer as well. So within those 3 categories, there actually are 22 investment themes that fall underneath those 3 categories. So if we take cleaner, as a starting point, right? The idea here is that there's a finite planet, and the world needs to do more with less. So really, the companies that are exposed to this theme are helping businesses improve their energy efficiency, do more with less, recycle content within their business, whether that's increasing the amount of renewable energy. So it's all about a finite planet doing more with less. The second kind of mega trend is improved health. And this is all about improving the quality of the lives of people that operate within the economy. And again, there's a variety of themes that can fall under here. But it could be things like improving healthcare, innovation in healthcare, or affordability of healthcare, providing education, or some things that are less obvious, but still very important, which are things like encouraging sustainable leisure. So the idea that as an economy gets richer and people have some more spare time, I know almost that sounds too good to be true, but to be able to have leisurable activities that are not damaging to the environment. And then lastly, we've got the third bucket, which is all about safety and resilience. So this is quite an interesting bucket, particularly for a sustainability fund manager, because there's quite a few financial services companies that fall within this category. So that includes businesses that are helping small and medium-sized businesses grow, or lending to small and medium-sized businesses, because we think that small businesses are really the lifeblood of an economy in terms of the sustainable economic growth, job creation, and innovation. So we really like businesses that help small businesses. But it can also be things like providing insurance, financial safety nets to individuals, to companies, or a theme that I expect will be very close to many of the listeners, or many of the watchers' hearts, which is saving for the future. This idea that there's a big savings gap out there. Unfortunately, we can't rely on the governments to necessarily provide attractive retirement options, and you can't rely on defined benefit pension schemes anymore, because they're unfortunately no longer readily available to most people in the economy. So the great thing is about this approach is this is our starting point when it comes to idea generation, but it means that we can build well-diversified portfolios, as you alluded to before, across lots of different sectors and lots of different themes, and not at all times, not all of those themes will be firing on all cylinders. They operate in different times of the cycle, the economic cycle, which gives you that breadth as a fund manager, which is really, really important, because it's just having like an environmental fund, for instance, means that you're likely to have to own certain types of companies regardless of the valuation, regardless of the upside that you can see there. So this kind of breadth of themes gives us an opportunity to really be well diversified.
Oh, that is excellent. Yeah, proper insight there into the themes that you focus on, and as you say, ones that are very, very important to the future of us on this planet. And let me add to anyone who's watching this that the Liontrust are very, very good at adding literature to their website, which goes into great details. The 22 sort of smaller themes within are all set out there, and some really good examples. I think what we'll do now, if I may, to build upon the discussion, we'll look at some case studies. We like to look at some of the good for people, good for the planet. You've spoken about theory. Let's put some meat on the bones, as it were. I know that you've pre-prepared 3 examples that you're going to run through, so I'll pass the baton back to you. If you can just give me a little insight into each of these 3, and these would be, as we call the mid-caps, not the giant megas companies that we all know about, but these are smaller, but still very large companies not everybody will know about. So please do run through those for me, if you will.
Yeah, absolutely. And just before I do, just to round off the discussion around the investment process, just to be very clear, that those themes are the starting point, right? And that's how we look and find and identify ideas. There's 3 more stages after that are very, very very detailed, oriented to make sure that company is eligible for investment. And each of these companies that we're about to run through tackle and meet all the criteria there. So is the company sustainable from a ESG perspective? So we do our own proprietary analysis. And one thing to really stress, where I think we're potentially quite different to many other companies, many other fund managers that do sustainable investing, is it's fully integrated. So it's everyone on the team, including all the fund managers, all the analysts, do all 4 stages. So they do the sustainability analysis of the themes, they do the sustainability analysis of the company, whether that company is eligible for sustainable investing. And then we do the business fundamentals, which, going back to that point before, 43 names, 5-year holding period, we can afford to be very selective over the types of companies that go in the portfolio. So we can have a very, very high bar. And actually, people talk about sustainable investing, how you lose, some of the universe. We're not going to invest in tobacco, gambling, arms manufacturing. We're just not interested in those areas of the economy. But where we lose lots of potential investments in terms of our process is the third stage, which is the business fundamentals. In truth, there just aren't that many really great businesses that you really want to own for 5 years or longer. So that's actually where lots of companies fall out of the process. And then lastly, we do valuation, and the valuation stage is just an output really of those first 3 stages, because we're modeling these companies, we're looking out 5 years. And I think looking out 5 years and being able to continue to do so during times of volatility and during an environment where we think the world is more short-term oriented than ever, because as a fund manager, you can check your performance not just on a monthly, but on a weekly, on a daily, even on an hourly basis. And clients are also doing the same. And that forces you to think short-term. Our team is very fortunate that the way that we're structured, the way that we think, the way all of our decisions are made are based on this 5-year view. So even if there's a company that looks like, the economy might be in a difficult place for the next 6-12 months, we can look through that, and that will come out in some of the examples. But I just wanted to flag that it's that the sustainable themes are the starting point, and then there's quite a lot of work that goes on beyond those.
No, we will come on to those examples, but no, thanks for clarifying that. And I mean, I've been advising clients for many, many years, and the phrase I always used to use is I use 2 hats, an ethical hat and a financial hat. And that's from looking at clients' perspective is financial planning. You're doing the same. You're not going to invest in something if it's got fantastic ethical merit if you just know it's going to lose money.
Absolutely.
And thinking long term as well is important. Anyway, again, thanks for adding that extra detail there. Maybe come to these examples now. So
yeah,
back to you. Tell me what you can.
Yeah, brilliant. So I've chosen 3 examples that I'm hoping listeners and watchers will not necessarily have come across before, and they are at that smaller end of the market cap spectrum. Obviously, if they're listed here, they're still quite large companies in terms of market cap, in terms of the liquidity and volume of the daily trades, but they're just going to be less well known, hopefully, to listeners. So the first one I'll talk about is a circular economy example, which is a company called Winmark. And this is a company that operates franchises of second-hand shops. So predominantly this is clothing shops. So second-hand clothes shops, but they also have a chain of second-hand musical instruments and second-hand sporting equipment. So the idea here is that in a world, we talked about finite resources, the best thing you can do from an environmental perspective is reuse. So recycling is great, and we should all encourage that as much as possible. But from an environmental perspective, the least amount of energy is taken when something is simply reused, and the amount of times that clothes can be reused when people no longer need them or no longer want them is actually quite high frequency over time. So this is a company that we identified in the lead up to launching the fund. So we launched the fund in July last year, and in the lead up to launching that, this is a company that we found had fantastic, we talk about business fundamentals, some of the best business fundamentals in the portfolio, extremely high margins, extremely high returns, as most franchise businesses are, but really fits the process from a sustainability perspective because of that reuse element in which is just ingrained throughout the organization, and clearly an interesting company to hold even for a downturn. People will often trade down. Instead of buying new clothes, they'll potentially buy second-hand clothes, because the average cost of the clothes in Winmark shops are substantially below what you would find in a normal retailer. So quite a resilient investment. Just to give you an idea of how off the radar some of these names are, though, to speak to the management company. Normally, a management company will have an investor relations department. They'll have some sell-side representatives, some brokers that cover that stock, and their job is to call up fund managers like me and say, look, you should be looking at Winmark, you should be buying Winmark. Winmark, unfortunately, for us, which we think is one of the nice things about it, it's very, very uncovered, unfollowed. There's no investment banks that cover that stock. And actually, they don't even have an investor relations department. So in the lead up to launching the fund, a big part of our process is to speak to management teams to understand the culture, how they treat their employees, etc. Particularly for companies, slightly down the market capitalization, like Winmark is. So we actually just ended up having to email. We messaged the CEO on LinkedIn, just explaining who we were and that we wanted a meeting to learn more about the business. So it just gives you an idea of the types of companies that are there in the US, but you've just got to be willing to go after them and do a bit of extra due diligence to come to terms with them. So that's a company that we absolutely love, and it's about 2% position. We actually sold it 3 months after the fund launch because it went up 35% almost straight away. And we couldn't, which is always the best reason to sell in terms of sell discipline, is when you've got no upside. So we actually had to exit the position, and then for a reason that we don't quite understand, the shares came down significantly, and then we were able to buy back the position. So again, that's one of the benefits of having a slightly smaller fund. It's quite nimble. If something doesn't give you the upside that you need anymore, then you can just exit it, even at these smaller market capitalizations. So that's the first one that I want to talk about.
I think you found a little gem there. I do like the fact it hasn't got this slick sort of external investor relations. They're all about the fundamentals, about doing what's right, doing it at a profit, getting there when you have.
Absolutely.
Excellent. I love that. Winmark, brilliant. Okay, let's move on to that second example.
Yeah, so the second one is in that same resource efficiency theme. It's a slightly bigger company. So this one's more, so Winmark's about $1.5 billion market cap. Trex is more like a $6 billion market cap, so much bigger. They make decking, so like garden decking, so outside decking, which 95% of the materials that go into their decks is recycled content. So we talked about our preference is always for reuse. Most of the time that's not possible, however, so the next best thing is recycling, and that's where Winmark really scores highly. So so to give you the context for where this idea came about, we've been following it for years, and then the pandemic happened, and we thought, okay, brilliant, the pandemic, companies like Winmark, Trex, these are discretionary items. People are not going to upgrade their decks. But because of the type of recession it was, everyone stayed at home, interest rates came down, there were lots of stimulus checks, their business took off and went to the right. So they actually had incredible sales growth, great margin expansion, and the multiple for the stock soared. So it was on peak earnings, peak multiple, which is a way of thinking about how expensive the stock is. So we were just sitting there thinking, well, we didn't see that coming, and then we waited and waited and waited. Fast forward to 2022. Sure, everyone is aware, the music started to change quite drastically there. Interest rates, inflation, all start rising, and then what the fears around people not willing to upgrade their gardens, their decks, that started to filter into the business. Sales started to slow, inventory levels started to build up with their distribution partners, and the share price fell like a stone. And that was when we were like, okay, this is our chance. So essentially, I jumped on a plane and went out to meet them. They're based in Virginia on the East Coast of the US. And I got a tour for about an hour walking around with the CEO, showing me all the facilities, because 95% recycled content is exceptionally high, particularly for a very high, this is a premium product. This is a beautiful product. It looks exactly like wood. But the great thing is, and the reason that every year it's called composite decking, because it's a mixture of wood and plastic, and every year composite takes share from wood, is because it's just much easier to maintain. So if you've got a wooden deck, you've got to sand it, you've got to oil it, it gets rotten, it gets slippery, it's a lot of maintenance involved. With a composite deck, you just need to hose it down once a year. So it's much more, and this is the thing, right? Like, US consumers are not buying Trex because of the recycled content. They're buying it because it's a better product. It's easier to clean, it's easier to maintain, it lasts much longer. So I wanted to see like how they got to that 95% recycled rate, and it's really amazing because the inputs are plastic bags. So they go to shopping, they go to the likes of Walmart, and they buy all these no longer needed plastic carrier bags. You can't reuse them again because they've already been used. So consumers don't want them back. And then they go to furniture companies that have discarded furniture that again is going to go to landfill, and they buy that and then they combine it together, and it's really like a recipe that they've refined for 20 years. You know, testing the different temperatures, testing the different pressures, the different amounts of ingredients, and it's amazing what goes in and what comes out. You know, it's really something to be seen. And you know, I came back from the US with this understanding of how that business operates, and going back to that discussion around everyone being very short-term minded, cast your mind back to mid to late 2022. The consensus was we're about to enter a massive recession, and it was going to be really painful, and it was going to be a terrible downturn. And that may well have been the case, right? And if we were having to invest and outperform over 12 months, we wouldn't have bought Trex, because obviously, why would you buy a consumer discretionary company like this? But when we zoomed out and we modeled the business for the next 5 years, and we saw what the upside was on a 5-year view on some sort of normalized earnings, thinking about through the cycle, it was just such a no-brainer. We thought the shares could double. So we started a position and we added to it. This is in the global fund now, but you know, in the back end of 2022, and this is a key stock in the US fund. And actually, the reason I wanted to talk about it is because they had results a couple of weeks ago where they're starting to show signs of slowing down. You know, the consumer slowing down in the US again, and there's concerns about a recession potentially, and the shares have fallen off significantly. And what did we do? You know, again, with that 5-year hat on, we added to that holding with that 5-year view in mind. And to try and outperform over the next 6 to 12 months, we wouldn't be doing it. But when we think in 5 years from today, that's where our confidence lies, and that's where we get really excited about owning these businesses that they've got a gross margin advantage from that high level of recycled content. So sustainability makes the business a better business, and that's what we love to see from our investment standpoint.
That is a good win-win, as the cliche says. And anyone watching this, TREX, Trex, if you want to look them up. And you'll know this already, but my typical client, I mean, that's absolutely food and drink to them. This is exactly the type of business they want to support and be invested in. So I'm so pleased you're invested with those guys, and long may it succeed over the long term.
Yeah.
I think your third example you're going to come to is something completely different, which is great. So tell me more about this.
Yeah, so we thought we'd go for something completely different. It's probably to our highest impact company, to be honest, across the whole portfolio, because you know what they do is in the healthcare space. It's a company called Transmedics. It's done remarkably well, right? Since we launched the fund, it's up, you know, well over 100% since in the past year. It's done even better year to date because it kind of sold off towards the end of last year. But they operate in the organ transplantation market. So the organ transplantation market, the current standard of care is an ice box. So you harvest the organ, and I'm very sorry if you are about to eat your dinner or something while you're watching this, so maybe listen to this section of the interview a little bit later on. But the current standard of care is to harvest an organ and put it on ice, put it in an ice box, a very fancy ice box, put it on ice, and then fly it to the recipient. Now, the problem with that is there's something called ischemic damage, which is if you starve an organ from oxygen, then it gets ischemia. So it's essentially the organ dying from having that oxygen starvation. So Transmedics came up with a solution where they said, okay, well, this heart, for instance, take the heart, we'll plug it into a machine where it continues to beat, and we'll infuse that heart with nutrient-rich blood to keep that heart beating and to keep that heart going. We can also then assess the quality of that heart, you know, and how well it's doing. What this means is that instead of having a very narrow and tight time pressure over transplanting that heart, you can actually put that on a plane and you can fly to the other side of the US and get that in the right organ recipient, right? Because it's very complicated structure about who gets what organs when, because there's a huge demand supply imbalance. That unfortunately there's so much higher demand for organs than there are supply, and it's not because there aren't enough people that are in theory willing to donate their organs. It's actually just the fact that this is a really inefficient process, and that the existing standard of care just isn't sufficient. So that's how they got started. This business is Transmedics, is by providing this solution that you plug the organ, whether it's the liver or whether it's the heart, whether it's the lungs, into the device, and you can monitor it. What they then realized is a big bottleneck in growing the number, because their goal is to grow the number of transplants, the organs that get transplanted every year, and that they've done a great job of doing this in such a short period of time already. But their goal, and what they realized the bottleneck was just the logistics around it. So, for instance, if you have to fly, and in the US you have to fly very regularly to transplant these organs, they were having to use a third party. That third party knew that they were desperate to get a flight, so they would charge them really high rates, knowing that was the case. So Transmedics have gone out and bought planes. They've got their own fleet of planes now to transport these organs as best as possible, as efficiently as possible, to keep the cost down to the healthcare system. And they've also partnered with surgeons that are local to hospitals all over the country. And that's another big thing, because what used to happen is, let's say you were a surgeon in New York, you would have to get up maybe at 3 a.m, fly to San Francisco, harvest that organ yourself, do that operation, fly back to New York, and then do the operation on the recipient. Now that, I don't know about you, but I don't want a surgeon operating on me after 20 hours of flying, so what Transmedics do is they've got this network. So they've got a surgeon local to that San Francisco hospital that can harvest the organ. They give that to a Transmedics official who looks after the organ on the flight. That they bring that to New York, and then the surgeon then wakes up when he would normally wake up and do that operation on the recipient. So that improves the patient outcome. So it's just one of those companies that is just solving so many simple problems. But in doing so, it costs money to do so. When we first bought shares, the company was a loss-making company. So one of the few in the portfolio, we don't tend to like to own companies that don't make money. The only time we'll do it is when we think that the company is just on the cusp of making money. Because if you can buy a company just before it turns profitable, there's a really good opportunity in terms of share price appreciation. And actually, by the first quarter of this year, it turned a profit. And now the company's making, a 10 to 12% margin. So fantastic example of marrying the business fundamentals with the sustainability solution. And this is business growing, over 100% a year, because they're just taking so much share in that organ transplant market. And the best thing is, from a societal good perspective, is that there's more organs being transplanted every year, which is what their end goal is. So it's been a fantastic holding for us. It's small, so even now, after going up the way it's gone up, it's probably about a $5 billion market cap. So we'll always size those companies appropriately to reflect that higher risk. But yeah, a company that we're delighted with so far in terms of the progress.
That's incredible. I mean, I don't think I've got anything to add to that. That's just absolutely incredible. Well done.
Yeah, it's amazing. Again, though, it shows because the shares halved. We launched the fund in July, and the shares halved in a matter of months to the end of October, and then basically quadrupled, since those October lows. So it's that ability when everyone else is panicking and trying to do things to make the short term look better. It's that ability to kind of sit back and say, no, this is what this company should do over the next 5 years, and to remain invested or potentially add to that position if you've got that conviction. And that's essentially the hardest bit of investing, which I'm sure everyone on this call knows.
Yeah, fabulous. No, I think you've given me a really good insight into this fund today, and those examples have just topped things off just brilliantly. I'll wrap things up very shortly. I don't know if you've got anything else that you need to add today. I think we've gone through quite a lot of stuff already.
Well, look, we try and always give a good flavour for the portfolio, and we try and be very open as a team, because we're cognizant this is your money, this is your client's money. So we every quarter, every month, we publish all our holdings for each fund. So look, if you're interested in investing in the funds, or you are invested, I really would encourage you, go on the website, see what we hold, and if there's question marks, because sustainability isn't always really obvious. We tried to use some of the really great obvious examples today to bring it to life, but it's not always that obvious. It's not always that clear cut to clients. So if you've got questions, like, do not be afraid to get in touch, and we'll very happily get back to you on those.
Brilliant. Yeah, no, you guys are always very open with the information that we require. And as I said earlier, there's some great literature. When I have client meetings, I often take some bit long or talk about some case studies myself. Thank you, Chris. That's been absolutely superb. I will just round this off by saying, although this is a great fund, from my perspective, take financial advice. This might be a great fund, but you're watching this, it might not be right for you, despite all those good things, because it depends upon who you are, what your circumstances are. So make sure you go through a good financial advisor, maybe somebody with good green money, somebody else out there does a good job. This video will be on our website. We've also got a YouTube channel. Do subscribe, and then you'll be notified of any future recordings that we do. Other than that, I'll just say thanks again, Chris, and hopefully I'll see you again soon.
Yeah, thanks very much. Thanks for having me.
See you later.